You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, we're in the heart of earnings season. It is Wednesday, April 22nd, 2022. The markets are closed at this point in time, and that's when we're taping Options Playbook Radio. Welcome. This week, we have many of the FANG stocks, a lot of the mega caps that are announcing earnings. Earnings are all over the place. We have had a roller coaster ride ever since Netflix announced their earnings and has done, let's just say, not very good after they announced earnings, which has brought the market down in general and a lot of the FANG stocks. So we have a few more that are going to be announcing. Well, we had Microsoft just yesterday and Google. Microsoft did okay today. It battled back. It started down. Google did not. They both had okay earnings. Microsoft ended up today $13 or about 4.8%, where we had Google down almost $90. It was trading down lower than that. It was a little bit all over the place, but finished the day down to $3 and 3.67%, I should say, not dollars. And this week, as always, we always have Amazon. They're going to be announcing earnings at the end of the week, Thursday on the close, which is always the situation with Amazon. At least they, for some reason, decide that they like to announce on Thursdays, which makes it very interesting for the option traders, mainly because, and we've talked about this in the past, that you have these very expensive option contracts and they have 1 day to live. We have Amazon trading today at $2,763.34. It's down $24.48 on the day. And we also have Apple's going to be announcing earnings too at the end of the week. We have Twitter, which is obviously newsworthy. Not quite sure where Twitter thinks it may go, considering that we have the buyout from Elon Musk at $54.20, but they will be announcing earnings, so that should be an interesting one to watch and see what's going on. But as usual, we're going to do a trade in Amazon. We usually look at some type of butterfly around earnings, and it's all about the fact that we're going to be looking at 1 day option contracts after they announce. And those 1 day option contracts are going to become 0 day option contracts. They're going to be very dynamic within that 1 day. Now, usually go back and we talk about last week's trade. Well, the market in general has been beaten up, but we're going to look at Disney. Disney, it has not announced earnings. They're going to be on the tail end of this earnings season. And we looked at doing a calendar spread in Disney. We looked to buy the May 13th expiration, which does contain earnings. It expires after the earnings announcement. And we bought the 132 strike call, and then we look to sell the April 29th expiration, which is just right around the corner, and we sold the same strike call. And what we mentioned on the show was that if we could get a chance to buy back that short call before the expiration date and roll out in strike, that we would do that. So at this point in time, when we sold that call, it was trading for around 50 cents. We now see that Disney has gotten beaten up, just like most, I guess, most of the stocks in general. But Disney right now is trading at 115. That option contract's going to expire worthless. I might even wait for it to bounce back a little bit before I went out and tried to sell the 132 strike call again. Or maybe we even come in and sell the 130 strike and try to raise some premium over that. Because bottom line is we want to be long the call going in to this option or into this earnings announcement. And this was one way to try to do that, protect ourselves a little bit, but to do it fairly cheaply. So the May 13th is the expiration that contains the earnings on Disney. We would maybe go out in time and look at the May 6th expiration, now that these option contracts are more than likely going to expire worthless, and look at selling the 130 strike call on the May 6th expiration, giving us one more week. And then if that happens to expire worthless, we can just roll right into a long call spread if we would like to. Each time we're selling these calls, we're whittling away at the cost of our long option contract. And as normal, as we approach the earnings, we expect the implied volatility of that 132 strike call to increase as that earnings report approaches, which is always a good thing. And that's the main reason why we always set up our calendars that way. We like to buy the long option contract that expires after the earnings, hopefully getting a bump up in implied volatility, adding value to that option contract. But I see in the future here on Disney, we paid $2 and approximately, if we're looking at the midpoint, about $2.40 for that long call option. So we just want to keep whittling away by selling calls against that position. And I would most definitely look to go out and maybe even sell, turn this into a diagonal, sell the 130 call. And then when that expires, maybe think about even selling another option contract with the May 13th expiration. All right. So let's now get into Amazon. Tough to get long almost anything nowadays. And in this instance, we've always looked at Amazon mainly to the buy side. And that has a lot to do with that we looked at a lot of skip strike butterflies. And skip strike butterflies like when implied volatility comes down. So normally you'll get a little bit bigger crush in implied volatility the day after they announce earnings, if the market is actually going up. Not to mention that the market just until nowadays has been fairly bullish. So this week, I think we're going to take an opportunity to look at a long put spread in Amazon. And once again, it's not meant to be a recommendation, but we haven't done a lot of long put spreads. So we're going to take that opportunity and we're actually going to do just a flat out butterfly. I do not like the risk in this marketplace of doing a skip strike butterfly or any fancy ratio butterflies that adds additional risk above and beyond any net debit or maybe even small credit that you might receive when you get a little fancy on your butterfly. So we're going to be short and sweet, and we're just going to do something about one standard deviation way. Well, I should say the expected move away. It's not necessarily one standard deviation. And we're going to do that to the downside. So we need to start by looking at where Amazon is at. Once again, it's Wednesday, April 27th. The markets are closed. Normally, I would look to do this a little bit closer to the close tomorrow on the 28th, because that's when they're going to be announcing earnings. Amazon right now is at $2,000. $763.43. So that makes the 2,765 strike the most at the money strike option contracts. So we want to start by getting the price of this long straddle. The long straddle will give us a feel for what the expected move is after the earnings announcement. And that's always usually where we want to start. So we do have pump up implied volatility. We got the VIX has been rising. All of the volatilities across the marketplace are pumped up. So this April 29th expiration right now is trading for $1.86. So we're going to go about that far out of the money on our 1 day long butterfly. And I guess we're going to be bearish. The whole marketplace wants to be bearish. So I guess we just don't buck that trend overall. So 2,760, if we just make the math simple, if you do 200 points from that, 100 points down would be 2,660, and we go another 100 points, that would be 2,560. So we'll do something around that strike. There's plenty of strikes available, and we're going to go fairly wide on this position. So we'll look to do the 2,570s. Those are trading for about $28 on the midpoint. That's the option contract that we're going to look to sell. We are going to go 20 points out. So 2,570 minus 20 points is going to be the 2,550. And plus 20 points will be the 2,590. So we have a 40-point area that we kind of want to land in. This is going to be a fairly inexpensive trade to do it. But our maximum risk, we did not skip a strike. We did not add a butterfly in. So we need it to be fairly cheap to do this trade in order to put that on. Because if we do not do it for, our risk is going to be our net debit paid for it. And who knows exactly what's going to happen in the marketplace. So in this instance, we're really doing a lottery trade, right? We're just going to be buying a lottery ticket in Amazon and see if we get the type of moves that we've been getting in a few of the FANG stocks recently. So if the market goes up, we're not in favor, but if the market goes down, we got a chance to make around 20 points on our 1x2x1 butterfly. And in this instance, we're going to be doing this for a net debit of 20 cents to the account. You could do it as many times as you want, but right now with the marketplace close and the stock at $2,763.34, our 1x2x1 butterfly, because of the jacked up volatility, is done for a net debit of 10 cents to the account if we can fill anywhere near that midpoint. That means our maximum risk would be 10 cents, and we're just looking for it to land within a 40-point area, basically, to the downside. We're just looking for that expected move. If the stock does reach that and you can sell this thing for 50 cents, we'll do it. We're not looking to try to make the $20 that's on the trade. You can obviously let it ride for this instance, but this will be a very interesting trade to watch because there is so much implied volatility just in the marketplace in general and in the mega cap stocks right now. We're looking at about 111% implied volatility on the at the money option contract for this expiration date. So just a lottery ticket, if you will. No 100% doing this trade because of the pumped up volatilities and the fact that Amazon is going to be announcing earnings. We took the standard deviation or the expected move, approximately one standard deviation to the downside, used that to set our strikes. We went to the April 29th expiration. We bought the 2550 put, sold two of the 2570 puts, and bought one of the 2590 puts, a 1x2x1 standard butterfly for a net debit to the account. All right. Well, that's it for this episode of Options Playbook Radio. If you have any questions you'd like us to try to address or answer on the show, please email them to me at theoptionsguy@invest.ally.com. Thanks for listening. If you'd like to learn more about all the events that we do at Ally Invest, just follow me on Twitter. My handle is @BrianOverby. And until the next time, may all the options that you bought finish into money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.